Markets don't like uncertainty. They like visibility. They like moats. So markets are a little scared today. To me, it's an overreaction. I mean, NVIDIA decline is the worst since March 2020. And we know that ended up being a huge opportunity for investors. So I think it's not a fun day, but I'd be looking at this as an opportunity.
I've been thinking about, the people who've been coming on today of all sort of professions, whether it's a strategist or investor or whatever, analyst, defending all this or saying it's overblown. How do we know? What if it's not? And if it isn't, what does that mean?
We don't know if it's overblown. You're right. But this is the nature of technology. I'd be personally surprised if NVIDIA became Betamax in the past week. I mean, that's really would be the kind of change that would be required to really justify selling NVIDIA here. And given, I think, the need for AI because of global labor shortage and NVIDIA chip dominance is still strong, unless a new model emerges that doesn't require GPUs entirely, I'd say that markets just generally do fire ready aim. I mean, I think it's hard to know, though.
I won't disagree with you on that. I mean, that's how the market tends to do that. But a lot of AI was sort of sold to investors on a hope and a dream, right? We haven't seen, in many cases, the ability yet to monetize all of this, or at least to have a sizable return on the investment that a lot of these hyperscalers are make tens of billions of dollars that they're pledging to spend. Doesn't that matter? I mean, what if some of that hope and dream just doesn't come to the degree that we thought, or we decide that it wasn't worth the money that we were willing to pay for it?
I mean, these are fair questions. If NVIDIA was at 100 PE, I'd probably say that there's too much good news priced in, but the PE is around 30 times. I'm not sure that that's very demanding for investors, and if you look a couple years out, it's in the 20s. I don't think NVIDIA is priced for perfection.
Is the market itself?
I don't think so. I mean, the 10-year now is backing off to 4.5, so you're still paying over 20 times for a 10-year bond. The median PE in the S&P is around 18 times.
Yeah, but I mean, because it's skewed, though, because of the mega caps, we're still like 22-ish times. So, earnings have to be really good from here on out, right? Don't tell me about multiple expansion again driving this train. You got to put up or shut up when it comes to earnings this period.
That's right. But, I've been researching companies since the early 90s, so over 34 years. I never found a PE for a high-quality company to be at 22 times, let's say for Mag 7, to be a demanding multiple. Again, I think if you're talking about price for perfection, it really has to be stocks where you have to back into the NPV of 100% earnings growth forever.
What happens if, at bare minimum, we are questioning NASDAQ stocks for the foreseeable future? Like, this doesn't feel like, tomorrow everything's going to be great kind of deal. So as long as we're doing that, is there enough momentum behind some of these other areas of the market that this market as a whole can be okay?
Well, today, market breadth's actually pretty good.
Yeah, financials, healthcare, staples, they're green. Dow's up, almost 200.
That's right. Even in NASDAQ, we have stocks that are up.
Apple, Uber, Meta, yeah.
And I think that year-to-date, we have 3 weeks in, and year-to-date, Bitcoin's outperforming, small caps outperforming financials. So I think the market does look pretty healthy. I would say it's also very encouraging that if we can close on the S&P above 5881 by the end of this week, it really solidifies that 2025 is going to be probably a double-digit gain year.
While the stock market is still surging right now, investor sentiment may be taking a turn. Around 34% of U.S. investors feel bearish about the next 6 months, according to a weekly survey from the American Association of Individual Investors released in late January. That's up from around 29% the week prior. While nobody can predict what the market will do, especially in the short term, some metrics suggest that a downturn could be on the horizon. The Buffett indicator, for example, suggests that a slump could be ahead. This indicator, made famous by Warren Buffett, measures the ratio of the total market capitalization of all publicly traded companies to U.S. gross domestic product, GDP. In 1999, Buffett used this indicator to predict that the market would soon face a steep downturn, a prediction that came true just a year later when the dot-com bubble burst. If the percentage relationship falls to the 70% or 80% area, buying stocks is likely to work very well for you, he explained in an essay published in 2001. If the ratio approaches 200%, as it did in 1999.
What's your favorite part of the market right now, outside of tech?
I think financials, to me, represent a pretty good fundamental case of change this year because we have a new administration, a Fed that is dovish, yields that aren't painful for banks, and at a time when it could lead to upside for capital markets activity and multiples are low. So I think financials remain our number one S&P sector idea.
I mean, because I ask you because your narrative is so levered, so to speak, to big cap tech. Your top 5 ideas in the market are NVIDIA, Amazon, Meta, Google, and JP Morgan.
Yeah.
Now, you're not rethinking any of that?
No, at the moment, no. And even though this one day is painful, I do think markets tend to overreact. And again, unless we're on the cusp of a recession, this pullback in NVIDIA is going to prove to be a buying opportunity as well.
Any Fed risk this week at all? Can they? Do you have any worries about what they could say? They're not going to do anything, we don't think, but you know they always say a lot.
Yeah, there's a lot of uncertainty going into January FOMC because last month it really caused markets to rethink the probability of a hike. But the probability of a hike for 2025 now stands at 27%. I think that's an extraordinarily high probability. I think there's a chance the Fed sounds more dovish than market expects.
Tom, we'll talk to you soon. It's good to see you as always, especially here post 9. It's Tom Lee, Fundstrat. Up next, big tech under pressure.
As of February 2025, the Buffett indicator has reached 203.51%. While this metric alone doesn't necessarily mean that a crash is coming, it could be wise to start taking precautions just in case. To protect my personal portfolio, there are 3 things I'm doing right now. It's always a good idea to have some cash stashed away for emergencies, but it's extra important when a market downturn could be looming. If stock prices fall, your portfolio could lose substantial value in the short term. As long as you stay invested, though, you likely won't lose any money. The market will eventually rebound, and your portfolio should regain any value it lost. However, if you pull your money out of the market after stock prices have dropped, you could end up selling your investments for far less than you paid for them, potentially locking in steep losses. If you don't have an emergency fund and you face an unexpected expense during a market slump, it's more likely you'll need to tap your investments at a less than ideal time. When the stock market is thriving, sometimes even shaky stocks can perform well. But a market downturn is the ultimate test of a company's fundamentals, and weak businesses will often struggle to survive tough economic times. The best way to ensure your portfolio pulls through the next bear market is to double-check that every stock you own is still a solid investment. Companies can change over time, so even if one of your stocks was a fantastic buy when you first purchased it, that doesn't necessarily mean it's still a strong choice now. Stock price alone doesn't necessarily reflect how strong a company is, so it's wise to look at metrics beyond this number, like the business's price-to-earnings ratio and its price-earnings-to-growth ratio. It's equally important to examine big-picture factors too, like whether a company has a durable competitive advantage that can help it keep up with industry changes. A competent executive team is also critical, as bad leadership can cause even strong companies to struggle. The future is uncertain, and that can be incredibly nerve-wracking for investors. If you're feeling scared about what may be in store for the market, that's normal, and you're not alone. In times like these, looking back at the market's long-term history can be helpful. In the last 25 years alone, the market has faced the dot-com bubble burst, which became one of the longest bear markets in S&P 500 history, the Great Recession, the COVID-19 crash in 2020, and the most recent bear market throughout 2022. Despite all of that volatility, though, the S&P 500 is up by more than 300% since 2000. If you'd invested $10,000 in 2000, you'd have nearly $41,000 by today, even after accounting for all of the severe ups and downs in that time. As daunting as they are, downturns are a normal part of the stock market cycle. While you can't avoid them or predict exactly when they'll begin, keeping your focus on the years ahead can make it a little easier to get through them. It's tempting to try to figure out where the market is headed and adjust your investments accordingly. After all, if you can sell your stocks at peak prices right before the market falls, you could make a hefty profit. However, if history shows us anything, it's that nobody can predict exactly where the market is headed in the short term. And if you buy or sell at the wrong time, it could be costly. This isn't to say that these experts aren't skilled at making predictions. Rather, it demonstrates just how unpredictable the market can be. Many economists and financial professionals have been warning that a recession is imminent, and yet the market has been thriving for over 2 years now. Of course, that doesn't necessarily mean that a recession isn't right around the corner, but the market's unpredictable nature makes it much more difficult to gauge when the next downturn will begin, which can make times like these even more anxiety-inducing for some investors. There's a major silver lining for investors. Nobody can say for certain where the market will be in 2025. But the good news is that with a long-term outlook, it's much easier than you might think to protect your investments, even if we face a recession or market crash. If stocks take a turn for the worse, your portfolio could lose value in the short term. But losing value is not necessarily the same as losing money. As long as you stay in the market until stock prices recover, you'll likely regain any lost value and end up back where you started. For example, say you invested in an S&P 500 index fund in January 2022. Immediately before the market began its descent that would last until October of that year. If you had panicked and sold your investments in, say, March, you'd have locked in losses of close to 10%, even though the worst of the downturn was yet to come.